Let's roll. We're right at 9 o'clock. I know people will be joining here coming up, but as you're all aware, we're very fortunate to have a special guest here, Louis Vincent Gave, my partner, great friend, and the founder of Gavcal Research. He's joining us all the way from Dubai, so he's 12 hours ahead. Hasn't even had dinner yet. So in fact, I think he just got out of a 3-hour traffic jam. So thank you very much, Louis, for putting up with all that to be with us. And if you don't know, if you've never seen Louis in the popular media, he's had cover stories in Barron's. He's been the subject of countless Wall Street Journal articles. Many of the world's largest money managers and financial firms are Gavcal clients. So this is truly a special event indeed. And we thought that based on the prevailing market euphoria, with many echoes of where we were 24 years ago, that this is a really timely topic. So as usual, when we do these, everybody but Louis and I are going to be muted to begin with until we get to the Q&A section, which will be in about half an hour. And at that point, we'll both be available to answer your questions. So thank you all very, very much for being here with us. I'm going to do a short intro and then hand the baton to Louis. So Louis is going to help me with the slides. We'll go to the next. There we go. So a few visuals about the parallels with now versus then, and in terms of the concentration. So if you go kind of to the middle of this, well, a little bit toward the right-hand side, that spike up toward the red dotted line was 2000. And actually, we're looking even more concentrated today. So this is the top 10% of stocks versus the entire stock market. We got a couple more visuals on this. So let's go to the next one. And again, very similar look. And these things have happened in the past, but the reality is this is one of the narrowest market advances ever. You know, it's called bad breadth or market halitosis. And it's, it's fun while it lasts, but the history is that these don't last very long. And what we don't know is, I mean, there's no question in my mind we're in a speculative blow off. What I don't know, and none of us do, is when it's going to end. But I think we need to be on alert about that, which is a big part of this discussion, okay? And this is comparing IT, technology versus energy. You know, back at that time, the great tech bubble of the late 90s going into early 2000. And it was, this is really kind of a deja vu experience for me, because I told people back in the late 90s that the NASDAQ was crazy when it hit 2,500. And by February of 2000, so 24 years ago, it was 4,600. And by the way, it was on its way to 5,000 in March of 2000. That's how, that's a classic speculative blow off where it just goes up and up and up, and you see this vertical line type of thing. And at the same time, energy was very out of favor, and I had a lot of energy holdings, so that was no fun, believe me. But there was quite the reversal of fortune, as you see here, and we're going to look at another one that also drives this home. But anyway, back in obvious thing that was happening at that time, and it's happening again with tremendous. No, you're fine. Keep going right to the flows. That next slide. So tremendous inflows into tech. There's different ways to measure this, but I think this just reflects reality that even if you look at 2021, which was also a very tech popular period with tremendous inflows into speculative stocks, high growth stocks, high multiple stocks. I mean, this year is running at a much greater clip than that, annualizing. Things could obviously change, but for now, this is looking pretty feverish, okay? Then we can look back at what happened with flows. So this shows the green bars here are indicating the inflows into tech funds back then. That was a huge warning to us at the time, because we really track what mutual fund flows are doing. When they get extremely positive like this, we generally get bearish on whatever that particular part of the market is. And as you can see, then after that, the white line is the NASDAQ. It crashed and went down almost 80%. And then people started bailing out. And that actually led us to start overweighting large cap growth around 2004, a little bit prematurely, but that turned out to be a pretty great overweight for well over a decade. So these fund flows are a very important heads up, especially when they really get out of normal bounds. Okay. Then this is interesting because I don't think people realize, many investors realize, that Qualcomm actually had a greater moonshot for a while. than even Nvidia. They've kind of converged here, but so this is the chart of Qualcomm back in 1998 to 2000 versus Nvidia for the last couple of years. And obviously Nvidia has been a huge, huge winner. I mean, one of the greatest winners in stock market history, but so was Qualcomm. It went up 1,500% in 1999. And I know there's some people on this call that were fortunate enough to own it back then. We stumbled into it during the Asian crisis when these stocks a lot of tech stocks got crushed. It was different than 2022. And if you don't remember, the NASDAQ was down 35% in 2022. But back in the late 90s, the Asian crisis didn't last a year. It was just a few months, but it was really painful. And that's when Qualcomm got down to around one-time sales. And I thought it looked awfully attractive at that point, and it turned out to be. Okay. So this is another parallel, which is looking at the Russell 2000 versus the NASDAQ. So the Russell 2000 is the leading small cap index. And what you can see is it went up over that period of time, but 39%, just about 100% lag versus the NASDAQ. And of course, people didn't want to be in the Russell 2000 because of that. There were huge outflows from small cap, all going into tech. So tech was like this black hole that was just sucking in all the money back in those days. Now, if we look at today to the next slide, we'll see not quite as extreme, but still kind of the same type of tendency. So the NASDAQ has gone up since the end of 2022. It's up about 16% versus 61.5% for the NASDAQ. So once again, the NASDAQ's leading the small caps in the dust. But here's what's fascinating. If we look at the next one, and this is why I think we really need to be thinking differently and not just chasing performance. So the blue line here to the left is showing where the NASDAQ was in early 2000. You can see that, very clear speculative blow off. It basically went from 4,000 to 5,000 almost overnight, and then started to break down. And then, and really, who would have thought that a couple of years later, the NASDAQ return and the small cap return would be roughly the same? But that's exactly what happened. And then over the next 10 years, small caps left the NASDAQ in the dust. So that just goes to show that when these bubbles pop, they can erase years and years of outperformance very quickly. And the laggards can come on to be the leaders also very quickly. So I think that's a very important thing to keep in mind at this stage of where we are in this particular cycle. All right, we'll do just a couple other parallels. We'll get to Louis, and one of them is what the Feds have been doing. So if this looks at what the Fed funds rate was doing back in the late 90s, it was clearly going up. There was a brief cut during that Asian crisis that I mentioned. That's that dip that you see in the fall of 1998. The Fed was also worried about Y2K and that transition, which turned out to be a non-event. So they just kept tightening and tightening and tightening. The market ignored it, kept going up, even as the Fed funds rate was rising. If that sounds familiar, it's because it is. That's exactly what's been going on lately. And then, of course, they start cutting and then raise briefly and then cut drastically after that. So let's look at what it's done today.
Sorry.
Oop, go back one more. Yeah, well, we know the Fed is, sorry, let's go back to the last one where we're going to look at actually that's the Treasury, that's fine. So we know the Fed has been raising rates and also the Treasury yields have been going up, and the same thing happened back in that same era where the 10-year Treasury yield went up significantly. So those are the parallels, which there are many. There are some differences. One positive difference is that IPOs, new issues, which were very prevalent back in the late 1990s. They actually peaked out earlier than the tech bubble itself. Even by the late 90s, early 2000s, they were still running at a very high rate, much different than today. So you can see the far right, it's quite subdued. We had a bit of the spike during 2021. But this is good news, I think, in that there's not this tremendous supply hitting the market of tech-related issues. So that's a positive. Now, on the negative side, we've got, if you can remember, it's hard to believe that just 25 years ago, the federal government was running huge surpluses, so huge that Alan Greenspan was worried that by 2010, there would be no treasury market left because we'd have paid off all our debt. And of course, that was another one of, terrible prediction by a Fed chairman. Instead, now we're not only running massive deficits, which are right in the $2 trillion area, about 7% of GDP, we're doing so in a very healthy economy, which is completely unprecedented. And that's a big part of what Louis is going to talk about, because I think we both believe that the ice pick headed right at this bubble is the U.S. Treasury market. So with that, I want to turn over to my great friend, Louis.
Well, thank you First of all, thanks to all of you for dialing in. I'm very flattered to be presenting to you here. Thanks to Adam and Mark for putting this together. And of course, thanks to my good friend Dave. Having just listened to Dave, I'm actually going to switch. I'm going to do a bit of a switcheroo here. 2 seconds. And I'm going to move to, it's not exactly the slides that we were thinking of presenting, but I think it represents, hold on, the important question that we're all confronting today. And where is that slide? Hold on 2 seconds. Sorry, I'm looking for. There we go. And this is a slide that I've shown. You guys can see it, right? This is a slide that I've shown time and time again, and it's my favorite table. And it.
I'm seeing is the IPO slide.
Okay, so I'm not on the right one. Hold on 2 seconds. Sorry, I may need to do something real fast. Apologies, everyone. My mistake. Give me 2 seconds. Boom. Screen. Oh. Up.
Okay, I think that's the one you want.
Yep. Sorry about this, everybody.
No worries.
This is on me. Everybody had everything well organized, and then I decided to change it. So sorry about this, but this is a table I've shown a lot over the past few years, the past couple of years, and I really like this table because it's got so many messages in it. So to explain what you're looking at the top 10 market caps in the world in different decades. And for me, there's 4 super important messages that come through from this table. The first message is that it's very hard to stay at the top. When you look through history, you've only have really 2 companies that have managed to stay decade in, decade out amongst the top 10. One of them is Microsoft. And Microsoft was in the top 10 in the 90s, in the 2000s, and the 2010s. The other is Exxon. Exxon was in the top 10 in the 70s, 80s, 90s, and 2000s. Although I would argue that Exxon sort of cheated its way into staying there by taking over mobile and getting big enough to stay another decade. So that's the first message. The reality is when you get very big, again, you get fat, you get lazy, you get stupid, and the governments come and pick your pockets. I think most governments they're very jealous of their powers, and politicians hate it when businessmen are more important than them. So when businessmen get important, politicians come after them. So that's the first message. Very hard to stay at the top. I think the second message is that every decade, markets seem to get very excited about something. And in the 1970s, some of you are older, may remember the Club of Rome. You may remember peak oil. The general perception was that there wouldn't be enough for everyone. And so you get to 1980, and 6 out of the top 10 companies in the world are oil stocks. And oil back then was 35% of the S&P 500. Then in the 1980s, the main idea was that if you didn't learn Japanese, you'd never have another job. And by 1990, 45% of the world MSCI was Japan. 8 of the top 10 companies in the world were Japanese. In the 90s, of course, we all got very excited about the internet because the internet was very exciting. And by 2000, most of the top companies in the world were telecom companies. Now, here's a fun bit on this, is if you go back to the 2000 projections on the data use and how much we would use telecom, etc., we've massively overshot it. We have. We're using way more data over telecom lines than today than was forecasted 20 years ago or 25 years ago. But yet telecom companies have, of course, been super duds. If you bought into the telecom companies in 1999 thinking this is it, we're going to make a lot of money through sending data over telecom lines, it didn't work out because you overpaid. In the 2000s, the very exciting story, and I was lucky enough to have a front row seat for that one, was the emergence of China. And, that had a huge impact on commodity markets and on businesses all over the world. That had a big impact, of course, on Chinese businesses, but on luxury goods businesses, on all sorts of exporters into the Chinese boom. And of course, the story of the past 10 years has been the story that software eats the world. That the only place you're going to find growth really is in the United States and is within software companies. And now, what's interesting to me is that today, of course, all we talk about is the Mac 7, is Nvidia, is how much capital spending we're going to be doing in AI. But there are other bull markets unfolding around the world. There's a massive bull market going on in Japan. There's a massive bull market going on in India. There's a bull market in Mexico, all of which are starting on valuations that are nowhere near as stretched. And so going back to the core presentation, I think going back to the point Dave made about the similarities. Hold on, let me do this. So, about the similarities with this bull market and the differences with the 1990s. The similarities, you've got a lot, and Dave highlighted this, a lot of the same share moves and the concentration of the market. All this is very, very reminiscent. Perhaps the biggest difference, which Dave highlighted, is this one. The fact that in the 1990s, hardly a day could go by without you hearing about a new IPO. And in itself, this ended up being a break on the market. If every day new companies come and issue capital, it drains liquidity, and after a while, it prevents the market from going up. If every day companies are coming in to get dollars out of the market to put it into their own bank accounts, those are dollars that aren't in the market anymore. And today you don't have that. Instead, the Microsofts, the Facebooks, the Googles of this world are all buying back their shares. So they're actually adding liquidity in the market. But as Dave highlighted, one key difference this time around, and I think it is a dramatic difference, is that in this cycle, you have, contrary to 1999 when the US government was running a budget surplus, you now have a US government that's running budget deficits of roughly 6, 7, 8% of GDP, while the US economy is running at full employment. So in 1999, the drain on liquidity was done by the private sector. It was companies issuing capital. This time around, the drain is very much being done by the public sector, by the government coming in and just sucking money out of the market. And all this leaves me with a pretty simple quandary. As we look, through these 10 stocks, the big question for me is, okay, what is the next big bull market? And you could say, well, just listen to the markets. Why fight a good trend? The bull market is AI, it's quantum computing, it's EVs. Now, one of the interesting things on this front is that on the EV side, things are starting to fall apart. One of the fun bit thing, if you had a portfolio that was 50% Nvidia and 50% Tesla, you're roughly even over the past couple of years. What you made on Nvidia, you've now lost on Tesla. And this, I think, highlights an important shift in trend, in that to me, it reminds me a little bit about, for those of you who lived through it, 99, 2000, everything was going up, and then the dot-coms imploded. You may remember that in March 2000s, all the dot-coms, all the flimsy business models that didn't stand a chance of ever making money, suddenly hit the wall. But then everybody said, yeah, fine, pets.com goes bust, but what do I care? What matters is really the telecom rollout. So I still should buy Lucent, and I still should buy Qualcomm, and I still should buy Cisco. And all these names continued to rally until August, until we realized, well, hold on. There's a certain level of incestuous relationships within the tech world, and if all the dot-coms go bust and don't pay Lucent for all the chips, the servers and the network equipment that they ordered, well, then Lucent gets to be in trouble too. I highlight this, because today we have, when you look at the semiconductor industry, that our markets are being driven by semiconductors, and on the premise that a demand for AI is going to keep driving demand for semiconductors. But the biggest consumer of semiconductor in the world is the automobile industry. And within automobiles, electric vehicles consume roughly 2 to 3 times as much semiconductors as an internal combustion engine vehicle. So we're now moving into a world where you are seeing the whole EV space start to struggle and struggle meaningfully. And you're starting to see more and more car makers, whether the Fords of this world or the Volkswagen of this world, starting to back away from promises of EVs. But yet projections for semiconductors remain absolutely sky high. Now, staying on this idea, I want to just highlight some simple maths of where we stand today. Today, the US is 18% of global GDP. It's 70%, 70 of global equity market cap, and it's roughly 4% of the population. Now, for this to make sense, we have to assume, if you project yourself over the long term, that 18% of global economy with 4% of the population will contribute 70% of the profits over the long term. I mean, that's what the markets are telling us. Now, do you think 18% of the economy can produce 70% of the profits over a 3-year, 5-year, 10-year period? To me, that seems very much like a stretch. Or perhaps there's another way to put it. If you look at the Nifty 15, what we've called, I wish I'd come up with the name Magnificent Seven. Although those of you who've seen the movie probably know that of the Magnificent Seven, only 4 survive and 3 end up dying along the way, which seems probably about the right ratio as well for this present cohort. If we look at, so I wish I'd come up with the Magnificent Seven. In our research, we talked about the Nifty 15. So your 7 stocks plus Visa, MasterCard, Adobe, Oracle, Intel, and a few others. So if you look at the Nifty 15, you're basically your top 15 tech or tech equivalent stocks. That Nifty 15 today is bigger than Europe. And you might think that makes sense. You might think Europe is condemned. It's the old continent. It's destined to be a museum, etc. But it's also bigger than Japan and emerging markets put together. And again, I'd ask you, if you look at the next 5 years or 10 years, would you rather own the top 15 tech stocks or the whole of Japan and the whole of the emerging markets? Where do you think more growth will come out of? For me, it's pretty much a done deal. I'd much rather own Japan and emerging markets, especially since those parts of the world also have very strong positive momentum today. And again, starting from much weaker valuations. But perhaps here's another parallel to 1999. Now, when I started in this business, my very first client told me, "Remember, Louis, it's an easy business. You have to figure out if there's more money than fools, in which case money tends to flow into markets and asset prices go up, or if there's more fools than money, in which case money comes out of markets to basically fund whatever needs people have." The idea behind this is that financial markets are, in essence, reservoirs for excess capital. When people have too much money and it ends up in the markets, and when they don't have enough, it comes out of the markets. So I've always, thought of markets this way, as this reservoir of excess capital. And if we look at this and we think, okay, let's look at the market cap of the markets relative to M2. How much money is there in a system to support the valuation of the stocks? On the red line here, you have the U.S. market cap to M2. And as you can tell, we're basically back at the levels of late 2022 when the market started to fall apart, or the levels that you had in 2007 before the markets fell apart. But we're not quite at the levels that we reached in late 99, 2000s, because back then, as Dave highlighted, the Fed was dumping money in out of the fear of Y2K. So that was, quite of an extreme level of injection of capital by the central bank, again out of fear of Y2K, but also because the world was still dealing with the hangover of the Asian crisis. You'd had massive devaluations in Asia in 97, 98, which had been a big deflationary shock for the whole world. There was, inflation was collapsing. So if you look at the US in that ratio of market cap to M2, you're basically in your top 5% of periods where this has ever happened. Meanwhile, in China, you have the exact precise opposite. In China today, you have a central bank that's pushing money in a bid to get the economy going again, and you have very low valuation on stocks because the market has been such a dog. Now, as you look at this relationship between market cap and M2, one of the questions for me as I look at the coming years is, I know that next year and the year after and the year after that, the US government is going to come into the market and tap the market for $2 trillion a year, additional $1 trillion a year. Because, those are the CBO projections or the IMF forecasts, but, the government is spending a lot more than it's taking in. And the ability of the government to increase taxes to close that loop is actually pretty limited. So as you look at this increase of money that the government is going to take out, we should all ask ourselves, where's that money going to come from? Now, one option, of course, is the Fed is going to provide it. Now, if the Fed provides it, if the Fed goes back to QE, goes back to monetizing the debt of the government, if the Fed goes down this path, then the dollar goes down. And then we move into a world where there's a lot of assets that are way more attractive in that world. And if the Fed doesn't monetize, then the money will have to come from out of the equity markets to fund the US government debt. And so all the frothy asset classes, whether your NASDAQs, your Bitcoins, where will the marginal dollar come from to keep pushing these things higher? Maybe it won't come from anywhere. So for me, the big question is it's pretty simple, is do you think the US government starts to crowd out the private sector and therefore the markets just run out of excess liquidity? They run out of juice. And if so, do the frothier asset classes tank or do they plateau? Now, in the history of financial markets, things that go up parabolic very seldom plateau. In fact, instead, they make a sort of Eiffel Tower formation where, it goes straight up and then comes back down on the other side. But if you think, nope, they're going to tank, then the next question becomes, okay, if tomorrow the NASDAQ, Bitcoin, et cetera, start to tank, does the Fed step in to help? And if you think, yes, the Fed will step in to help, then the US dollar goes down, emerging markets do very well, gold outperforms, and you just want to be in emerging markets. If you think, nope, the Fed will sit on its hand, then the US dollar stays strong, probably Japanese equities do well, as do Mexican equities. So, there's a lot of similarities between 99 and today, but by far the biggest difference is the funding situation of the US government. A funding situation, again, that will require $2 trillion a year to come in out of somewhere, and to keep funding this. And $2 trillion is a lot of money. So on this, I think Dave and I would love to take any questions.
Thank you, Louis. Great job.
I'm happy to jump in with a question. Thank you for sharing that. And certainly understand and can't argue with the logic here. Help me understand what's the case where the Fed does not step in to help. I mean, as a practical matter, don't they really not have any choice? Because, if rates were to go up to the level that would be required to really attract the capital that the government's going to need, well, then the entire, sort of government, we're in chaos. And the insolvency of the government becomes more readily apparent. So, hasn't the math gotten to a point where the Fed's going to have no choice but to step in and help. Or
Yeah, yeah. Look, Mark, I think you're absolutely right. What you're describing is fiscal dominance. What's described in in the textbooks is fiscal
yeah,
dominance,
absolutely.
where the central banks just lose its its independence. And this comes back. We all learned in our textbooks that central banks have two mandates. First mandate is inflation, keeping inflation in check. Second mandate is making sure there's decent growth. Uh, the reality is they really have three mandates. And the third mandate is by far the most important, and that is to make sure that the government stays funded. And the reason it's the most important if you're the Fed is that if the government doesn't stay funded, then you working at the Fed won't get paid at the end of the month. So if you're working at the Fed, it matters a lot that you can get paid at the end of the month. So yeah, no, I agree with you, but let's look at it a little bit differently and ask ourselves, okay, how could this be somewhat different? Or why would, if you think $2 trillion is a lot, and the Fed is going to have to step in, how could it not? And I think the only way you get to how it could not is you have a big crisis somewhere, where a big crisis that really freaks out investors, where they think, oh my God, the world's falling apart. I better rush back into the warm comfort of US Treasuries. And there's only really two big crises that one can think of that would be big enough. If tomorrow, I don't know, Brazil hits the skids, it's not big enough. There's only two economies that are now big enough for people to freak out and rush back into US Treasuries all on their own. One of them is Europe. So if Europe, and you can make up many crises in Europe. One of them is, the war with Ukraine gets worse. Poland gets involved. Before you know it, it's like a pan-European war, complete debacle. So people rush back into treasuries because of this. Or alternatively, you can make a scenario of, for some reason, the euro starts blowing up. AFD comes to power in Germany, or Rassemblement National comes to power in France. And the euro starts to blow up, and everybody runs for the comfort of US Treasuries. So that's one possibility. Another possibility on how we could be wrong is, China seriously implodes. Now, I don't think this is going to happen. In fact, I think a lot of the China is already bottoming and picking back up. A lot of the Chinese New Year data look to be pretty decent. In fact, I think we'll look back in 3 years' time and we'll say, okay, so in 2024, companies like JD.com that have 31 billion in cash were trading for 37 billion. They're trading at 5 times cash flow, and they're growing their cash flow by 10 times earnings. Why didn't I just load the boat? Especially given that the Chinese government was stimulating. And I didn't load the boat because I was afraid that China would implode because Xi Jinping's a bad guy, because he's going to invade Taiwan, because this, because that. But so that's your other scenario. Like there's a huge problem in China that goes beyond the ability of the Chinese government to control it or to do anything.
But to follow up on that, okay, fine. So, in a crisis, there's a short-term bid for, U.S. Treasuries and dollar assets, but also, crisis means recession. We're running, sort of wartime, crisis level deficits today that if we truly do hit that recession, or crisis drives it, the 2 trillion funding gap becomes, way higher. So, I mean, don't you still, even in those scenarios you're describing, yes, you get a crisis bid for treasuries, but how long does that bid last? That's not persistent. And aren't you right back to the Fed has no choice? I mean, I just haven't seen how the math works. I mean, I know Luke Groman talks about, if there's some sort of productivity miracle, maybe AI can be the answer. But do you disagree with sort of that notion that it is?
No,
yeah, okay.
I agree with it, but I think look, I think we are entering fiscal dominance in the US, and I think that's where we're heading towards. And deep down, in that decision tree that I showed, I'm very much at the top. I think I think the Fed will step in to help, and the US dollar does go down, and emerging market debt and gold and China and all these things outperformed. That's how I'm positioned. But you always have to ask yourself whenever you make your scenario, whenever you deploy capital, is okay, how could I be wrong? You know, how could I, how am I going to get kicked in the ass on this? And for me, like, I think we are heading towards that, unless perhaps if we have a big European crisis, or unless if China completely implodes. I think, to your point, you know, we're heading towards that, unless there's a massive course correction in terms of U.S. fiscal policies. But you know, right now, and this is not me making a political statement. I'm not American, so I shouldn't be criticizing American politics. But from neither the right nor the left in the U.S., is there any talk of tackling this fiscal policy issue? There just isn't. I'm not placing a value judgment on that. I'm just stating a fact. That there's, so that course seems to be set. And by the way, initially that course feels pretty good. Dollar goes down 20%. U.S. industry does better. You know, emerging markets boom on the back of the weaker dollar. Initially, everybody's happy. So there's no real pushback against that scenario, right? Like, there's no U.S. policymaker today. Both Biden and Trump are, nobody talks about a strong dollar anymore. I grew up in the 90s when every U.S. Treasury Secretary, each time a U.S. Treasury Secretary was given a microphone, they would talk about how they were for the strong dollar. Who says that anymore? Nobody, because you can't credibly say it when you're running budget deficits of 6 or 7% of GDP with full employment. I think Jeff had a question.
Jeff did.
Yeah.
Good morning, and thank you for doing this. So Powell goes on 60 Minutes and says, Congress, get your act in order. The San Francisco bank, Fed bank, comes out and says, Congress, we got to do something. The minutes last week come out and say, this is getting kind of messy. I'm kind of old, and I don't remember the Fed ever taking a position like this. And I'm wondering how I should read into that. Meanwhile, I agree with you that keeping the Treasury market functional is the Fed's prime purpose in life. But I'm wondering if there's a difference in whether they do that by cutting interest rates, or using their repo facility, or doing what they did when the banks got in trouble and they lent them money at face value of depreciated assets. Do those things matter? And in any event, no matter what's going on with the numbers you're presenting, and I agree with, is there any way to avoid a major bout of inflation here as a way to get out from under the debt? And that's about 4 questions. I said them as fast as I could.
So I'll start with the last one. Look, I think we're in an inflationary world. And to your point, you know, when you look at the amount of stock of debt that we have, the unfunded liabilities that we have, you know, inflation is self-default, right? And it's a default that's the least painful to go through. And it's the default that politicians always prefer because they're not held responsible for it. So that's yeah, I don't see how we avoid it. The question is, you know, whether it's smooth over time or whether it comes back and forth. But yes, I think we are heading into an inflationary world, unless again you get like one of these 2 big crises that I talked about as a sort of tail risk to any inflation scenario. Now, I've been thinking a lot along the lines you just asked, where the Fed indeed does seem to be firing bullets at the U.S. Treasury, at the U.S. government, which it has done in the past. Now you could say, well, they're just returning the fire, because if you remember, Yellen came out a couple months ago, and in essence basically told the Fed, well, obviously these guys are done rising and they should start cutting, which is also, you know, like U.S. Treasuries aren't really supposed to tell Fed directors what they're supposed to do, right? So to your point, I think there's Yellen, you know, started firing first. Maybe Powell's response is, you know what? Don't tell me what to do. Get your own house in order. You know, clean in front of your own yard. before you start worrying about mine, kind of thing. And yeah, maybe that's where we stand today.
Oh God, you're saying it's all just infighting. That's what we need. That's constructive.
Well, why
Okay,
should we expect them to be any different than everybody else in Washington, D.C.?
I guess we shouldn't.
Vivek, looks like you have a question. Go ahead.
I think you're on mute, Vivek. Vivek, if you can hear us, I think you're on mute. Okay.
Okay, let me,
Question, go
well,
ahead.
well, yeah, let me just chime in here because I think it's such an important topic while Vivek tries to unmute. It sounds like it looks like he's got a tech problem that's not letting him do so, but I do think this is really, I mean, there's so many things we can talk about that are important in the world these days, but I think this is it. Because really, why do we have a healthy economy right now? Why do we have a very frothy stock market? Why do we still have interest rates that are at relatively low levels, even though they're way up from where they were a few years ago? And I think it's strictly because the federal government is able to run these massive deficits and get people to buy them. And it's not QE anymore. Actually, we have QT. We have the Fed selling. We've got banks selling. I'm talking about domestic banks. So they're not big buyers of treasuries as they were supposed to be by, according to some pundits. We've got the foreign central banks selling. Got an awful lot of big sellers out there with not very many buyers. And kind of what Jeff was alluding to is what happens to the deficit in the next recession. And the next recession, the deficit's going to explode. And could we have it? Because backing up a second, a big decision for a portfolio manager is, do we buy long-term bonds in expectation of the next recession? The problem is if those deficits go postal during that next recession, which is almost unavoidable, I don't see how they don't, then the supply just becomes absolutely overwhelming. And there's a lot of evidence, I think Lou would really agree with this, that the long end of the US Treasury market is actually quite fragile right now. So the government has a very difficult time terming out its debt. It missed its opportunity back a few years ago when we had the 10-year Treasury get down as low as 0.5% or 0.53% to be accurate or precise. And they really weren't able to do extension of their debt maturities back then, unlike individuals did with refinancing mortgages, unlike corporations did as they extended out their maturities of their debt. So the federal government's extremely vulnerable to these rising interest rates. And it's not just the new money, it's also the rollover. Louis knows this a little bit better than I do, but I believe there's $9 trillion of government debt coming due over the next 12 months. And the assumption is, oh, that there'll be plenty of buyers for it. But as we've already seen, the buyers are kind of going away. So, we know these bubbles don't last forever. And if I have to name what is going to be the #1 pinprick for this tremendous latest speculative mania, it would be the US Treasury market. Okay, enough
So
of that sermon. I think Vivek is trying to tell us what he wants us to hear.
Yeah, no, I've got Vivek's question, but on this, I just want to add something. So I think it's over the next 12 months, the U.S. has to roll over 8 trillion and issue another 2 trillion. Now, historically, roughly a third of the debt is owned by foreigners. And here I want you to put yourself in the shoes of a foreigner. And again, I don't want to sound like I'm criticizing U.S. politics or because I'm not American, even though my kids are and my wife is. But so it's not my place. But if you're in the shoes of a foreigner and the runoff looks like it's Trump versus Biden, as a foreigner, it's an uninspiring runoff, perhaps as an American as well. But as a foreigner, it's especially uninspiring because you have one of the two candidates that openly says he doesn't really like foreigners in the shape of Donald Trump, and another candidate that frankly looks past his prime, without wanting to sound rude. So if you're a foreigner and you've got a bunch of debt rolling over, out of that 8 trillion, if a third is held by foreigners, do they just re-ante, or do they say, you know what, let's wait till after the election. Let's just wait to see how this one works out. Let's wait, or do you even buy more? Because they do need to out of that 2 extra trillion, foreigners should be buying 600-700 billion of it. Given the politics, do you wait? If 10% of the foreigners wait, then all of a sudden you got a big hole that you got to make up somehow. So anyway, Vivek's question, the first question was on India. And I think it's an important question for those of you who participate in the Indian bull market. But the question is basically, how much of incremental dollars would you commit to India over the next 2-3 years versus US and versus Japan? So I actually think that for the next 6 months, India is a bit of a dangerous market. And I think this for a couple of reasons. First, it's had a spectacular run. It's pretty overbought. It's pretty expensive. And a lot of the bull market depends on Modi winning re-election. So, this year, it's obviously a US election year. It's a European election year, but it's also an Indian election year. And Modi has, over the past 10 years, he's done much better work than any of his predecessors in terms of rolling out infrastructure and getting foreign investors excited about India. Now, logically, Modi should win re-election pretty comfortably. But the way things run in India, it's a first past the post system with lots of regional parties, etc. If the BJP, Modi's party, does badly, then there'll be an election backlash. So right now, I guess India's price for perfection coming into an election, and that always leaves me a little bit worried. So that's number one. Number two, the other thing for India, I'm sorry I don't have the chart here, but over the past 5 years, basically India and China have had a -1 correlation. India goes up, China goes down, China goes up, India goes down. And the reason for this is, I think, pretty simple. That the two big markets in Asia, they're actually the two big markets across emerging markets. And so everybody and their dog has been overweight India, underweight China. But again, if China starts to build a little bit of momentum on the back of these decent economic data that's starting to come out, then people might say, okay, I need to take some profits in India, redeploy back to China. So all this to say, I wouldn't buy India now. I'd wait till after the election, after the Chinese rally that seems to be starting. And then now on a 3-year view, I still think India is a good place to be. And I would rate that roughly the same as Japan. Japan's a different story. Japan's a valuation story. The yen is the cheapest currency by far in the world. It's just crazy cheap. And the Japanese bull market is a broad bull market. You go to Tokyo today, you can't spend money if you try. The yen is so cheap. I think for Americans today, it's cheaper to fly to Japan and ski in Japan than it is to go ski in Colorado. On AI, I don't know if you want to take that one, Dave. I've got some thoughts, but basically the question is, how sustainable is the Nvidia financial stock performance? A good friend of mine sent me this. I don't know. I got to model it out, but if you assume a $740 share price on Nvidia, you basically are hoping that Nvidia can maintain its monopolist operating profit margins of 55%, not only for this year but for the next decade, while also growing sales, while simultaneously growing sales around 8 times to more than $600 billion. Now, to put things in context, this year the whole chip industry should be about $600 billion. So the valuation assumptions on Nvidia are really quite heroic now. I would add one last point on Nvidia and whether it's sustainable. The big challenge for me when I look at Nvidia, and again, like, don't go out and short it, because when these things go parabolic, they can double again. But when you look at Nvidia, 40% of their sales come from the other Mag 4s. So your Amazon, Google, Facebook, etc. Nvidia is now 60% of these guys' capex. So where does the growth come from here?
Yeah, I want to comment kind of along those lines, Louis, and remind people that Nvidia is a chip stock. And historically, notoriously, chip stocks are extremely volatile. And one reason that they are is that when you get into one of these up cycles, and this has got to be the mother of all up cycles, at least for Nvidia, you get a lot of double, triple, and even quadruple ordering. And I think that's what's going on right now. And somebody just asked, well, what is the unknown? And I think nobody knows how much of that order book is because of what I just described. And if that starts to hit the wall, which it always has in the past, now maybe this time is different, but as we know, those are very dangerous words in the financial markets. So I would say that's something that could go wrong if there is an epiphany that, oh my gosh, their sales, they pulled forward, a year or so, or maybe just a couple of quarters worth of sales into their current backlog. That could be a very, that's what could lead to a 30–40% almost overnight correction.
I think another question we just got is, okay, the concerns we've been discussing are fairly well known. And it's true, they're in the Wall Street Journal and Barron's all the time. What are the potentials unknown that could really affect the market? And is the risk more in the downside, in your opinion? Look, there's always so many different risks. You can make a long list. I think if we look back at the past year, for me, one of the biggest surprise of the past year was how U.S. oil production moved from 12.2 million barrels per day to 13.2 million barrels per day, with really little increase in capex and really little increase in employment. I think basically U.S. producers got very good at sweating their assets. Whether they can continue to do this for me is a big question mark, because if U.S. oil production goes back from 13.2 to 12.2, then oil prices, move back to $90–95. Inflation reaccelerates, yield curve steepen, and all of a sudden we're in a very, very different world. Now you could say that's not an unknown risk. It's, people talk about higher energy prices all the time, but to me, when I look at the current setup we have, where everybody seems to be betting on a return to stable disinflation, etc. The big risk to that is, that's one big risk. I would say another big risk is that all this money that China's trying to pump into their economy starts to leave the bank accounts where it's sitting now, and you start to see stronger growth in China. So I don't think all the risks are to the downside. You can have upside risk on energy, upside risk on China, with a consequent impact on global growth and commodity prices and lots of other things.
We just got a question on the banks, but before we move on to that, I just wanted to chime in here again, Louis, because you're in my wheelhouse when you're talking about energy, as you know, and I totally agree with you that there's way too much complacency about the U.S. being able to maintain its production up around 13 million barrels a day, or even more than that. And if you don't know, if we would go back 15 years ago, U.S. production was more like 4 to 5 million barrels a day. So it has had an enormous increase in production. It's really the only part of the world that's grown oil output over the last 15 years. Who would have thought back then the U.S. was assumed to be played out? But it was, of course, the shales and primarily the Permian Basin. And I know some of the people on this are aware of this because I've written about this and talked about it. But the main reason the U.S. has been able to do that with a falling rig count. So the drilling rig count has actually been down over the last year, and yet production is up. How did they do it? They did it primarily because of something called drilled but uncompleted wells, DUCs. And what happened was during the COVID lockdowns, there were a lot of wells, thousands of wells that had been drilled, half drilled, and were shut down. Kind of like if you're in the home building industry and COVID came along and the belief was, oh, we're not going to sell any homes, let's just stop the ones we have under construction. Well, with housing, that picked up very quickly, took a little longer with energy, and you had this enormous backlog of these drilled but uncompleted wells, and particularly in the Permian. Remember, the Permian is the most important basin in the world, the United States and possibly the world. Now that, if you look at it, and I do have that chart that I'm going to run here soon, it has absolutely collapsed, and it looks like it's at rock bottom. And I think that's something that is way off the radar of almost everybody. What we hear is a lot of negativity on oil, including from Louis and my mutual friend Doomberg, who I've been writing on lately. And so I think this would be a big surprise if all of a sudden the Permian Basin not only quits growing, but actually starts to shrink. And I think that day is very near at hand. Okay, so maybe now we should segue to the bank question, which is from Sterling, that the banks don't look that healthy in his view. And I would certainly agree with that. That's, I think, one of the the flaws, the chinks in the armor of this bull market is it has not at all been led by financials, especially by the regional banks. A little fun fact is that the Magnificent Seven right now are 64 times the market cap of the regional bank index, which of course is totally unprecedented. But Louis, any comments you want to make about the US banking system?
Yeah, there is actually. So look, I think right now we're living through the implosion of two separate asset classes. One of them has been the Chinese real estate market, which has completely imploded and been unfolding for the past 5 years. Lots written about. A lot of companies have gone bankrupt, and the Chinese financial system has been able to slowly but surely digest this. I think the other asset class that is starting to implode is the whole U.S. commercial real estate asset class. And here, people are focusing a lot on the exposure of commercial banks and especially regional banks to this. And this coming year will be particularly telling because you have about $900 billion of debt rollover coming on U.S. commercial real estate. And so, a lot of trouble may be starting to appear. Now, the reality is before you even start thinking about all the loans, and by the way, a lot of the regional banks have been falling pretty hard on the back of fears of exposure. I think the bigger issue is, before you start thinking about the loan losses, it's of course the equity wipeouts. Before you get to the loans, first you go through the equity. And who provided all the equity for all this U.S. commercial real estate? The reality, it was mostly U.S. pension funds. When interest rates went to zero or thereabouts, and pension funds still needed to earn income, Wall Street came knocking on their door and said, "Hey, look, we got a great asset class for you. We'll syndicate commercial real estate. We'll put leverage on it, and we'll guarantee, and we'll give you returns of 12, 15, 16%. Of course, we'll take big fees for our trouble, but it'll work out well for you." And so U.S. pension funds, whether your CalPERS, your Texas Teachers, your MERS, I'm picking names, but all your big ones, they all did a lot of U.S. commercial real estate. And for 10 years, you put in 100, and the next year after you value it at 112, and the year after you value it at 125, and so on and so forth. And now you come in 10 years later, and the guys come in and knock on your door and said, "Yeah, that real estate that you think is worth 225 on your book, it's actually worth zero. It's not that you're going to make a zero return. It's actually the equity's being wiped out." And so a lot of pension funds, I think, in the U.S. that were already underfunded, they're the ones who are going to carry a lot before you even get to the regional banks. They're the ones who are going to carry a lot of that loss, which will then mean higher state and local taxes in a lot of places that can ill afford them. Either that, or it'll have to be once again monetized by the central bank. So I'm highlighting all this because, we saw the real estate blow up in China, and we're sort of 4 or 5 years in. We're just starting to see it in the US. And yes, one of the places you are starting to see it is regional banks. But what I'm more worried about is actually the pension funds. I think Jeff has another question.
I kind of got a follow-up, Louis. I can't believe I hadn't realized that what was going on between the Fed and the Treasury might be characterized as a war of the egos. But that implies to me that Powell is going to be even more reluctant to lower rates than he might otherwise have been. And of course, the Fed has always been late to the party in terms of lowering rates. What happens when he's sitting there like a kid holding his breath till he turns blue as things go south on us?
Well, I'll take the other side of that. That made me laugh. But I would say, look, right now nominal GDP is growing 6-7%. Unemployment is very low. Should we be talking rate cuts? Maybe having a central banker that tells the federal government, "Look, get your house in order. I'm not going to be providing free money," is maybe that's what's needs to be said, even if he is going to provide them free money. But maybe that is what needs to be said. I'm not sure. But
I think you're right, and I hope so.
yeah.
But Louis, you're raising an important point that I don't think gets enough press, is if we're running, and we are, 6 to 7% of GDP deficits and nominal GDP is 6 to 7%, where's the growth? Where's the private sector? I mean, could you argue that we're already in a private sector recession right now? If we were to normalize the federal spending, how strong would the economy look? Not that we're going to, but again, it gets back to how long can this go on? Will at some point the bond vigilantes ride again, as they did actually in the third quarter of last year? And people kind of forget about that. I think it's another one of those things that is likely to come back up again, just like I think the banking crisis is likely to rear its ugly head again.
I want to go back to this because you're right. In the third quarter, bond yields touched 5%, and then they precipitously rolled over, both on the premise that the Fed was going to cut, but there was something else that drove the bond yield rollover, and that something else was the perception that China was imploding. The data coming out in the fourth quarter was ugly. Perception was, oh my God, China's imploding. It's going to export deflation to the rest of the world. Renminbi is going to devalue, so on and so forth. Now, we've never got the renminbi devaluation, and now the Chinese economic data is starting to pick up. So the whole, and instead, it's not like, if you're looking for a recession, it turns out actually it might not be in China, it's in Europe. It's Europe where the data is starting to be really, really ugly. But the part of the rollover in yields was the fear of a Chinese implosion, which I think is now in our rearview mirror.
Looks like Vivek has another question. Can you text that to us or email it?
I guess while he's doing that, I'll jump in with a follow-up as well. Look, consensus, at least among this group, certainly seems that the U.S. debt deficit's unsustainable and we're headed toward calamity. Have you done any work really on assessing the likelihood that AI could be the productivity miracle that allows us over 3, 5, 7, 8 years really get out from this otherwise math that suggests there's no way to avoid calamity?
So let me butt in here. I think first, the productivity miracle of AI is going to take it's not going to be a click of the finger. It's going to be a decade-long thing. And the fiscal situation is deteriorating very rapidly now. So I think the trends, unfortunately, don't, even if you want to have optimistic forecasts for AI, I don't think you get there. More importantly, the US did have a massive productivity miracle over the past 10 years. And Dave mentioned it. The productivity miracle was the shale boom. The fact that the US went from 5 million barrels per day to 13 million barrels per day, in essence, adding a Saudi Arabia to its production was an enormous game changer for the US economy, because all of a sudden the US had a much cheaper cost of energy than anybody else. And it had a huge impact on the US trade balance. Now, what did the US do with this productivity? Did it use it to improve its infrastructure, improve, I think you used it to optimize uploading of puppy videos on the internet. And in the industry, while you had the cheapest cost of energy and you should have repatriated all the industry, you didn't. And even in the industry where you were completely dominating, like Boeing, you even let that slip apart. So I'm very skeptical on why the AI would be such a productivity boom for the US and not for everybody else. I'm not saying like AI won't be good, but everybody else, like whatever the US can do with AI now, everybody else can do as well.
And Louis, don't forget, it wasn't just the oil miracle, it was also the natural gas miracle, which was even greater.
Yeah, of course. Yeah, of course.
So it's more like 2.5 Saudi Arabias.
it was really thanks to natural gas that the US had a much cheaper cost of energy than anybody else. Because oil is decently fungible around the world, right? So price of a barrel of oil in the US isn't that much different from anywhere else, but but natural gas isn't that fungible.
And so with such strong views that, there really is not, a visible path toward dealing with the structural problems that policy leaders have created.
No,
Why
there is a
is-
path. There is a path. It just takes political courage and fiscal consolidation.
Well, I
It
should
just
say not a
takes.
realistic path. Cutting entitlements. No one's running for office that can get elected on the path that requires the type of cutbacks that I think you're alluding to. Would you agree?
Yeah, but you know what? You get enough inflation. So first, the path always goes like this. It's like the 1970s. It's like the 1970s in the US and in the UK, like Argentina today. You get enough inflation, people get really pissed off about inflation, and they say, "Fine, I will tighten my belt to beat inflation." The U.S. did it in the 70s. The UK did it as well with Margaret Thatcher. Argentina is doing it now. So it's just a cycle. So now the U.S. is going to go through its inflationary cycle, and after it goes through the inflationary cycle, some politician will stand up and say, "You know what? We have to tighten our belts to beat inflation," and that guy will win the votes.
One thing I do want to point out that's so different today, at least in the US, is our debt levels. So in the 70s, the debt to GDP, federal government debt to GDP was kind of 30 to 40%. We're now put a 1 in front of that. It's about 130%. So it becomes extremely difficult to let interest rates run up to where they probably should be. I'm not saying it can't be done, but it's, there's a definite downside to that. And what we're really seeing right now is the acceleration of the federal government's interest costs, and I don't see that ending anytime soon, especially as the lower yielding debt rolls over, which, as Louis said, is about $8 trillion coming up over the next year. So the cost of that's going to go up by multiples. And then at the same time, you've also got the entitlements, which our beloved politicians have been so good at kicking down the road. And now those were off balance sheet and off income statement liabilities are now having to be paid for. And that, guess what's in the trust fund, Social Security Trust Fund? Nothing but government IOUs. So again, I do just get back to what's going to really be the wake up call, what's going to be the ultimate reality check. I think it's going to be the Treasury bond market going into riot mode. And that is really not expected now.
And for us as investors, US Treasuries were the Michael Jordan of investments. They were the all-time all-stars. They were awesome. For 30 years, they were the clutch investment. And each time, things went bad, you could count on them to show up and have, and save the day. And the reality is, so far this decade, you've had 5 drops of 5% or more on the S&P 500. The S&P is the red line. And long-dated bonds is the blue line. And in every one of the drops in equities, bonds have done nothing for you. That bonds have now have the same correlation with equities, and not the same long-term profile. So they no longer provide diversification. They no longer cushion your portfolio on the downside. So they're just not that useful an instrument now. But it leaves all of us, if you used to run an easy 60-40 portfolio, 60% equity, 40% bonds, if your 40% in bond is no longer doing the job that you want it to do, then it leaves you with the question, okay, what do I replace the 40% I used to have? Now, there are other anti-fragile assets, but none of them have the low volatility of bonds. So gold is anti-fragile, but it has much higher volatility. Energy is anti-fragile, but it also has massive volatility.
Louis, along those lines, what about emerging market debt? I know that's certainly more volatile.
Emerging market debt's done a great job so far this decade in diversifying portfolios and delivering positive returns. It's absolutely crushed U.S. Treasury. So that's another one, but it is also more volatile, especially for U.S. investors, because you're also taking exchange rate risk. So I think
they're more volatile than the U.S. Treasury used to be. Now the question is, are long Treasuries going to be volatile as they? So I actually totally agree with you. I think long U.S. Treasuries are becoming risk on, not risk off assets. I think that's a huge change most people aren't aware of.
And so what you have to do is that 40%, let's say, that you used to have in US Treasuries, you now need to parcel out and say, okay, maybe I do 10% in emerging market debt, and I do 10% in gold, and I do 10% in energy. And together, hopefully that gives me the return and of that I used to get from US Treasuries with the low volatility. But it's no, it makes portfolio construction much more challenging. Absolutely no doubt about it.
We're running a little longer than we usually do, but we rarely get this opportunity. So I think anybody wants to stick around, stick around. But as soon as we run out of questions, we'll call it a day or a night in Lou's case.
Thanks a bunch, guys.
All right, thank you.
Time to say goodbye to Dubai.
Exactly. Would you buy, would you sell? Thanks a bunch.
Thanks, everybody.